We've got another treat for you today from the Real Vision archives. This one with Jim Grant and legendary short seller Jim Chanos. Short selling, as Jim Grant in this interview calls it, is the subtle art of selling something before you own it. Now, that can be quite a dangerous ordeal, but Jim Chanos has managed to be successful in this throughout his entire career. And Jim Chanos shares in this interview his philosophy that has made him successful. So without further ado, please enjoy this interview with Jim Chanos and Jim Grant.
Can you state your name, your title, and company?
Yes. Oh, I should do it.
Oh, please.
Yeah. I'm Jim Grant. I'm the editor of Grant's Interest Rate Observer, and what I do for a living is write. I want to interview famous people, but who are famous perhaps for reasons that the public is not fully aware of. I hope to elicit from them new thoughts, frank admissions of things that they had not previously admitted to, and I want to get them to laugh once or twice. I'm Jim Grant, and I am going to sit down with Jim Chanos, who, as you know, is the foremost short seller on Wall Street, the longest live short seller, the most successful practitioner of that very dangerous and interesting art of selling stocks before you buy them. Jim is a renowned analyst of companies, the author of The Truth on such situations as Enron and Valeant Pharmaceuticals, so please do join us. Jim Chanos on Real Vision, just one moment. Well, I am Jim Grant, and this, my guest, is Jim Chanos, James S. Chanos, proprietor, chief cook and bottle washer, founder of Kynikos Associates, leader of the financial resistance on Wall Street, eminent, long-lived short seller. Jim Chanos, welcome.
Glad to be here.
You know,
that bottle washing thing might come in handy, by the way.
well, everyone needs a real skill.
Exactly.
Yeah. A conference that Grant sponsors many years ago. Chris Davis, a very good investor in financial stocks, was talking, and he was quoting his grandfather, Shelby Colum Davis.
Sure.
And he said, you know, my grandfather said that the short sellers, they always sound smarter. What could he have meant by that?
I think there seems to be a collective wisdom on Wall Street that since stocks have tended to go up over time, or so I've noticed, that anyone who's on the short side, you know, must be sort of a little bit of an intellectual crank. But the fact of the matter is that while the indices have gone up over time, most companies don't. And most companies actually either fail or are merged out of existence. And so one has been, I think, well served to be long the indices, but it can be very, very difficult to be a stock picker over time. And I think that statement, expresses not only the wonderment of being a skeptic in a rising environment, but maybe also the difficulty of being a bull in a rising market.
Well, that line of Chris Davis has got the most rueful and knowing laughter, I think, ever at a Grant's conference in more than 30 years. Maybe just I'm sensitive.
Well, consider the audience.
Yeah. But speaking of 30 years, we have known each other for, I think, about 33 years. We met in 1984.
We did.
1984 it was. And it was dinner at Chris Sella's, which is a...
What we're showing you here on our YouTube channel is just the tip of the iceberg. No matter where you are in your financial journey, whether you're a beginner just looking to break into the market or a financial professional looking to up your game, Real Vision has something for everyone. Every day, our team of expert journalists provides in-depth analysis, written reports, access to live streams, and access to our community, The Exchange, where you can interact with people just like you from all over the world. For just $1, you can unlock all of this and more at realvision.com. Try our Essential tier. If you like what you see, it's only $20 a month thereafter. So click on the link in the description, go to realvision.com, and see what you think. We look forward to seeing you there.
Speaking of 30 years, we have known each other for, I think, about 33 years. We met in 1984.
We did.
1984 it was. And it was dinner at Chris Sella's, which is a great steakhouse, I think no longer with us, but it was certainly great in its time. And Bill McGarr another short seller, and you and I sat down together, and we had it figured out. As I recall, we had it figured out that the Drexel Burnham was not for the ages, that Caterpillar tractor was a kind of a fandango, and that people didn't have enough to read. That was my view of the world. If only I could supply them with a few thousand words every 2 weeks. So the three of us had the world figured out. What went wrong?
I remember that our mutual friend Bill McGarr was railing at the fact that Caterpillar had scaled the lofty heights of 12 times earnings. After a 2-year economic recovery, as I look at it today, at 30 times earnings. Yeah. I think it worked out pretty well for the three of us, all things considered. But boy, I mean, it sure seems to have taken a bumpy road to get there.
Yeah. Well, speaking of getting there, you grew up in Wisconsin. You went to Yale. You were a pre-med student, and to this day, some of your early friends and no longer young friends call you Doc, which is kind of an allusion to a one-time ambition. Science Hill turned out to be a very steep climb. You chose to switch major. You were in the crew team, were you not?
I was. They call me Doc, sort of as you call a fat guy Slim, as I was pre-med for, I think, 5 days.
Right. So you made the summers fly by during your college career by working in a steel mill.
I did.
And earning $14 an hour, which I gather was a munificent rate of pay, at least in comparison to your first Wall Street job. Where did you start on Wall Street, and how did you get from that job to Kynikos Associates in 25 words?
So my first job, I went back to Chicago after graduating, and I'd always actually had a fascination with the stock market. My dad was a stock market investor. So while everyone else either went to the commercial banking world or on to grad school, from my class, I decided to send my resume out to some of the big investment banks in Chicago. And I got an interview with a fellow from Blythe Eastman Dillon. And midway through our interview, he said, "Look, I'm going to hire you, but why the heck do you want to work on Wall Street?"
This was 1980.
This was 1980. Interest rates were 14%. We were in the midst of basically the 1966 to 82 bear market, which in real terms was as bad as the 30s. People just weren't making a lot of money. You mentioned my last summer in 1979, I worked 2.5 months in a steel mill and got extra shifts and took people's weekends and holidays. And I made more in that 2.5 months than I made my first full year on Wall Street. So a little bit of the difference between labor and capital back then. Labor was ascendant, capital was on its back. And then it, I think, changed a little bit.
So tell us, if you would please, about your first big analytical project having to do with a conglomerate called D.H. Baldwin.
Yeah, the wonderful Baldwin United. So I moved in 1982 over to a little firm in Chicago called Guilford Securities. The head of Guilford had been the head of retail sales at Blythe, and we became friends. And he told me one day he was starting this firm, office in New York, office in Chicago, and they needed analysts. And I actually was still far more enamored with the stock market than I was doing deal books for McDonald's. And so I took the leap and joined Guilford. And the first stock I was asked to look at was a company called Baldwin United, which was a rapidly growing conglomerate, the old Baldwin piano. And it was run by a CEO that had basically made his chops selling pianos door to door.
Morley Thompson.
Morley Thompson. And if you can sell pianos door to door, you could pretty much sell anything, I suspect. And but they had morphed. They were buying MGIC, the Milwaukee-based mortgage insurer run by Max Carl. And we had clients that owned MGIC stock, and it was basically a risk arbitrage analysis because there was a wide spread on the deal. People were questioning Baldwin's ability to pay for it. And as I delved deeper into it, I began to realize that Baldwin was not what it appeared to be. And thus, I put my, with an exquisite sense of timing that I've kept through my entire financial life, I put my first Cell research report out on August 17th, 1982, which some also might note was the beginning of the intergalactic bull market to the day.
Good call.
Exactly.
So tell us the price of Baldwin United at which you put out your Cell and the price at which it reached its, what's the word, apogee?
Yeah. So again, this was something that I think I wanted to sort of start a tradition in. So it was, I put my sell and sell short report out on $24. And
Or 25 was the top?
Well, it immediately went to 20, and then of course, almost tripled. And I think got to about $55, $56 in the space of a few months.
So tell us all what that experience was like, and whether somebody came to you, you were what, 23 or 24? 20,
yeah, I was 24, 25.
Okay, so somebody must have come to you in the firm and said, Jim, what an exquisite job you did on this analysis. You must have gone to Yale, it reads so well, but should we just kind of reverse this because it's really not working out?
Yeah, it actually sadly was a little bit worse than that because the New York partner wanted my head on a plate. And my boss in Chicago, the great Bob Holmes, said, now I've seen the kids work, we're staying with it. And
now, was the firm short?
The firm's clients were short, and I think the principals were short. I don't think the firm's capital was short. And we put out a second report in early December of '82, which basically, in effect, doubled down on the idea, but put out more information.
At what price about?
I think it was about 50, 52, something like that. And there was more public information out, and quite a bit. We were getting the files from the Arkansas State Insurance Department, which were public. And in it, the consultant for the department, who was a former New York State Insurance Superintendent, Stewart, was basically outright saying, "You are insolvent. We need more capital." And that's kind of, as we call it, a little bit of a smoking gun. But the company, Baldwin, was selling its annuities through Wall Street, so it had this amazing choir of supporters who just loved it no matter what. So I guess as a short seller, it might be a better education to have the first one double on you than maybe work out right away. But it did work out.
So those were the early 80s, 82 or so. We first met in '84, and by that time, another great theme was playing on the organ of Wall Street, which was junk bonds.
Yeah.
Through the support and sponsorship of Drexel Burnham Lambert. Tell us about how you got involved with that.
So I got involved. I moved to New York in '83 and joined Deutsche Bank, and as a sell-side analyst. And one of the companies I started work on was a company called Integrated Resources, which was the great real estate syndicator of the '80s. And Integrated was financed by one Michael Milken at Drexel Burnham Lambert. And as I began to look at why they would finance this company, which ultimately failed, I began to look at some of the other companies that he was financing, and a pattern emerged. It became very clear to me that one of the geniuses of what Milken was doing was that a lot of his clients had regulated financial subsidiaries, savings and loans, insurance companies, or banks. And one of the side benefits of him financing the various different parent companies was that they bought each other's bonds. And in effect, it was a way for money to be upstreamed from the regulated subs. And I think that was basically the underappreciated aspect of the Drexel money machine. The problem was, of course, it made the whole thing far more interconnected than anybody dreamed, and that if one or two of the companies should fail, you would have a possible domino effect, which is indeed what happened.
So the dominoes began to tumble in 1989-90.
Yeah.
So let's see, there's 1984, 85, 86, 88.
Yeah.
So tell us about the intervening 5 years between perception and the world's recognition. Emotionally and intellectually, how do you persist in these themes? And how, I'll get back to, I want to get around to risk control as well, but
sure.
Let's stick with the analysis and with the emotional problem of sticking with something in the face of relentless negative reinforcement.
Yeah, so the negative reinforcement is the issue. And as I've said for the last number of years, I think it's one of the reasons why I now believe that short sellers are sort of born, not made. I think you have to have the temperament. The research should be the same. The work you do should be the same, but you have to basically take your positions in the face of almost always overwhelming criticism of it from the other side. Whereas, on the long side, all of those people are the heavenly choir. It's the Muzak of the investment business. It's always on. It's always there supporting you. So you have to have a willingness to stake your position out based on the facts and your reading of the facts and how you see the opinion trading on those facts. And it's not always easy, even if you've been doing it for a long, long time. But I do think that quality is what separates people who have, well, at this point, I guess, survived on the short side versus the people who sort of flit with it from time to time.
Well, there are very few survivors.
Yeah, I think both of us are kind of battered.
Right, yeah. So tell me about how so that's the analytical side, the emotional side of it.
Yeah.
Tell us all, please, about the risk management side. Let's say you get an idea, call it a $50 stock,
right?
And there's no doubt this stock is a goner.
Well, there's always doubt, but yes.
Right. Well, I'm going to interrupt myself and you to quote you. This has to do with banks. I guess the year must have been 1990, and banks were all going down and vast heap. It was going to be 1932 again. And somebody said, this is like shooting fish in a barrel. And you said knowingly, yeah, but the fish shoot back. Getting back to risk management. So it's $50 stock. The case is pretty clear. It goes to 60.
Right.
It goes to 80. It goes to 102, as these things do.
Yes.
How do you trade around this?
Right.
I mean, how do you persist? Seth Klarman will say if he's long a $50 stock and he is persuaded by the case, really convinced by the case, he will buy in scale, buy more as it goes down. You can't do that exactly on the short side, can you? How do you
So of course, the short side, there's lots of asymmetries, but the biggest one is the psychological asymmetry of a stock can only go to zero, but on the downside, but can go up infinitely on the upside. And I always point out I've seen more go to zero than infinity. But having said that, it is people also tend to think far more discreetly about their short positions than their long positions.
Discreetly meaning?
Meaning that they isolate the price movement of one stock in their portfolio and disproportionately worry about it because of that fear. So remember, we run a portfolio, and so globally 60 stocks, domestically 40 or so. And so every position on basically averages 1.5% to 2.5%, something like that. So you always at least position your portfolio from a risk point of view that being wrong either permanently or temporarily can never carry you out. So we were famously and disastrously short America Online in the late 90s. I think we started shorting at $8 and covered our last share at around 80. And we were shorted on accounting reasons that played out fabulously from 2000 to 2002, which made us nothing. But during that entire period, that 10-bagger cost us a few percent because we were never short more than 0.5% to 1% of the fund in AOL at any given time. So you have to learn to size positions based on a variety of different factors, and some of that is the secret sauce of what we do. There's one other important point to make, and that is beginning in the 90s, we changed fundamentally and strategically the business to basically, in effect, be long the market for most of our funds. So we get paid, even in our short-only business, by how much alpha we provide. So we are, in effect, long the market, short our stocks. And this sort of changed the business for us dramatically because it basically put us in the insurance business, not the market speculation business. And I think that was one of the things that has enabled us to survive and occasionally prosper. That we really don't care that the market's up 30%. We just don't want our stocks to be up 40%.
Yeah, you care. Oh, it can be brutal, but there are bright lights. Speaking of the 1990s, please tell us about Enron.
Yeah, so Enron was one of these situations, and people always doubt me when I say Enron was actually one of the easiest shorts we ever had. We put the position on at about $60. It skyrocketed to 80, and of course in a month or two, which is a given.
Do, yes.
And then rolled over and never, pretty much went straight down with a few short rallies in the succeeding 11 months. And in the world of short selling, it probably doesn't get a whole lot easier than that. In addition, Enron, in terms of what we read and got our hands around it in late 2000 to put the position on, we were introduced to it via the Texas Wall Street Journal and a now colleague of mine, John Weil, who wrote a piece talking about Enron getting, and the energy merchant banks getting SEC approval to use mark-to-model accounting for their long-term derivatives. And this was something I was well aware of going way back to the Baldwin United days, who did a similar thing with their annuity policies. And in the hands of an unscrupulous management, it gave a lot of incentives to, shall we say, have a more optimistic view of the future profitability of anything you sold immediately. In any case, when we started going through the documents, things just started completely jumping off the page of their 10Ks and 10Qs, not least of which was these odd offshore partnerships in which a senior executive of the company was the general partner, and they existed to primarily do business with Enron, which, should have yes, so indeed. And then to quote the late, great Doug Millett, my partner at the time, when I pointed out that the Enron was earning about 6 to 7% pre-tax on its capital, he said, yeah, they're a leveraged hedge fund sitting on top of a pipeline.
Well, that was a phrase, leveraged hedge fund was the phrase you used when you presented Enron at the Grants Conference.
Yeah, and I did it.
But at the time, that was the first look, right? It turned out to be much more.
It turned out to be much worse.
Leverage hedge fund.
So we didn't think it was a fraud. For most of the time we were short it, we thought it was, like a lot of our companies, a company that was too aggressive, right? But that was within the confines of GAAP accounting, but GAAP accounting you can drive a tank division through. And we thought Enron was just another example of a company that was probably earning a little bit of money, but not the $2 or $3 or $4 that the street thought they would earn. And it wasn't until the revelations after Jeff Skilling left in August of 2001 where I began to really get suspicious, and the revelations in September, October that came out that Enron had given the investors in those offshore deals a secret put provision that they would make good any losses with Enron shares. They never told their shareholders that. And of course, it's one of the reasons why Skilling resigned, because should the stock go down, it had the vicious cycle aspect of massive dilution.
Now, people use this expression on Wall Street to press a bet. You said a moment ago that no position in your fund ought to be, or is, no position is bigger than like 2%.
Well, no, we have actually a 5% limit in the domestic fund. And
how big did Enron get in the book?
Enron was the maximum position. I mean, we kept that. We kept that as much as we could.
Down?
We did. In fact, our biggest ad was the day Skilling resigned. The day Skilling resigned, the stock went, to me, inexplicably from $36 to $40. And because people thought that he was the problem, and that by him leaving and Ken Lay taking over, that everything would be fine. And we saw it exactly the opposite. We saw the rats leaving the sinking ship, and that Skilling was the latest of a number of executives who had departed over the past 2 years, and that such executive departures were not a good sign.
How do you implement these ideas? Is it strictly with the equity? Is it with options? Is it with the
For the most part, it's equities. Every once in a while, if option premium are either too rich or too low, we'll put a position on any puts or short calls. But for the most part, 99% of the time, it's pure equity. And this, in Enron's case, it was pure equity.
People do complain about stock loan and difficulty and the cost of borrowing stock. And in fact, Overstock is supposedly getting into the stock loan business through the magic of blockchain. What's the blockchain? Anyway, what do you say to that? I mean, is stock loan a thing? Is it a problem? I mean, can you get the borrows you want?
Well, so the problem, as I see it with blockchain, and blockchain's been around for 10 years, the idea behind blockchain is basically a practically unbreakable cryptography that enables the financial world to bypass third parties, in effect. So if I want to borrow Enron shares to sell them short, why do I need to go through Morgan Stanley or Goldman Sachs? If you're a mutual fund and you have it on loan, you and I can do a transaction direct to each other and cut out the middleman. And while that sounds good, the problem I see it as a fiduciary is that in many cases in these situations, you want a middleman. You want someone as a traffic cop. You want someone to clean up the fails. You want someone to basically domicile. And in many cases in finance, you want a third-party guarantor, right? In terms of the whole idea of banks being irrelevant, because we're all going to do banking via peer-to-peer, well, given the characters I know out in the real world, and you know out in the real world, and the amount of fraud that is evident in all kinds of corporate transactions and financial transactions, sometimes it's not so bad to know that you have your bank in a federally, your deposits in a guaranteed institution. And that's the reason one of the reasons banks came to exist.
Well, we've talked about Baldwin, talked about Drexel, talked about Enron. Let's go to Valeant and tell us about that perception, analysis, implementation, and compare that, please, to the preceding famous hits of your career.
Well, there are some parallels, and one of the parallels is Jim Grant was present at the creation of a number of those ideas, because you were, I think, at my conference in February of 2014 when I gave the idea to a group of us.
I was, and I scrupulously approached you and asked whether I could.
You did.
Fine. I think is word steal. I think borrow in this case.
Yeah, and paid the price accordingly, as we both did for a year or so. But so that was an idea that when we began looking at it, it helped to sadly have a little pattern recognition in history, because when we were working on the idea and the analyst assigned to us going through their acquisition accounting, the partners at Kynikos all looked at each other and we all said, Tyco International. This was sort of as you remember, Dennis Kozlowski was the king of roll-up accounting. And it was very apparent to us, among other sins, that Valeant was performing aggressive accounting on its acquisitions. And so that was the genesis of the story that I gave in February of 14 and you reported on. As it developed, it began to morph into something far more ominous. The use of third-party support for overpriced pharmaceuticals, undisclosed deals. I mean, lots of things that we now know about. But again, like many Kynikos ideas that you were on the front lines for, it went from 130 to 10, but stopped at 260 first, and so doubled on us.
You hear it sometimes said, in fact, often on Wall Street, that timing is everything. No, it's not.
It's really hard. It's really hard. Everyone says, "Well, why don't you just wait?" Two things.
Wait to the top.
We'll wait to the top, and what's the catalyst?
Right. Ah, yes. That's
and sometimes you can point to catalysts, but most of the time catalysts are only apparent with 20/20 hindsight.
If we knew what they were, wouldn't that be lovely?
Well, and might the stock not know it too?
So where's the market going to go? Well, you laugh. I think that it was early on in our acquaintanceship that I discovered that you wouldn't give an opinion. I think it was at a grants conference. Somebody said, "So what do you think of this market?" Yeah. You refused.
Yeah.
That was an acquisition of wisdom, was it not? That you were not in the business of macroeconomics.
Right, and generally the market goes higher. So, I mean, my answer, I guess, would be higher.
How would it have been if in 1982 you had kind of become a room temperature Wall Street guy and put a little bit of money into the market and compounded it at these delicious rates,
right,
and had stayed home on the weekends and and lived a quiet life of internal compounding.
Yeah, it would have probably been more lucrative, but also a little bit more boring.
I gave a testimonial for, by the way, ladies and gentlemen watching this, we are as thick as thieves. Jim hired Emily Grant, now Emily Turner, as an analyst, and I don't know, we've known each other forever. But
by the way, one of the best analysts we ever hired.
Oh, thank you. David Swenson, the truly famous investor at Yale, was in conversation with I've forgotten, but it was the Council on Foreign Relations.
Right.
And the question came up about what is really out of favor. And David said, well, I'll tell you what's out of favor. Short selling's out of favor. And you know how I know this? Because they're discontinuing the index that we use to track short sellers, all 2 of them. So if you don't take a view of the market, and you don't,
Right.
what cues do you use for, you must watch the market?
No, we do. Of course we do.
And is this an unprecedented sign of overwrought bullishness, or is this just par for the course?
This is up there. So we obviously, when we add value for our clients, it's in our outperformance, right? As I quipped, I'm in the insurance business, but there's a certain truth to that. So we're hedging portfolios, and hopefully we're doing it at a positive return to the client as opposed to a cost. And that's the crux of our value proposition to our clients. So I've always said, if you are a good short seller, it enables you or the client to be more long. Either they don't sell stocks or they can keep higher exposure. But there are periods, and even though we've had excess returns in double digits for 30-some years, that there's stretches where it's nothing, and then there's stretches where it's 20 to 30%, right? So it's feast or famine, and this is due to both market cycles and the type of market cycle. This drought, basically, over the past handful of years is akin to the one of the early 90s. We had a similar one from 91 to 96, punctuated by 6 months of terror in 1994 when the Fed raised rates. But other than that, it was just a tough slog. The days of iOmega and others where concept stocks rallied for years on end until, ironically, the dot-com boom kind of ended it. The dot-com boom focused everyone's attention in a narrower and narrower group of stocks, and most other questionable company stocks started not keeping up in 97 and 98. So 98 to 99 were 2 fantastic years for us.
How interesting,
yeah. But this period.
Anything like that today? Is it 98 or 99 or is it 1995?
I think it's 2018 from what I can check.
Yeah,
they're always they're always different. But I would be remiss to point out there is now speculation clearly breaking out in the retail world, whether it's digital currencies. And by the way, it's not just the U.S. I just was contacted by a reporter asking me if I was short the South Korean small cap index, which apparently has gone parabolic and trades at over 100 times earnings. And so this is not.
It's not a good thing to be short.
Well, I think I'm going to pass because the South Korean authorities take a dim view on short sellers. But I think But for lots of reasons, my point being is this is not just happening in the U.S. It's happening globally. And now after 8 years of a bull market, the animal spirits of the masses have been roused.
You are an uncredentialed financial practitioner, as far as I know. You're not a CFA. You're not an MBA.
Correct.
This is autodidactic stuff. I mean, it's a little bit suspicious. How did you learn what you learned? Yeah. I mean, is it like sex, learning it from the gutter like we all do, or is it more systematic pattern of study for you? What have you learned? How? And importantly, what have you had to unlearn?
Yeah. So it was on the job training pretty much. When I looked at Baldwin United, which was my first deep dive, it turned out Baldwin was a highly complex company with insurance subsidiaries. So I literally had to learn how to read statutory insurance statements. But having a blank slate was, I think, a bit of an advantage because I just simply asked lots of questions. And then, the dirty little secret about finance, the world of quants notwithstanding, is it's not rocket science.
It's long division.
It's lots of arithmetic and a lot of common sense, hopefully. And so you can be trained to look at companies and look at what seems to make sense, and then intuitively, hopefully, ask the right question. If you're intellectually curious, that's the biggest attribute I want to see in my analysts. Can you ask questions that are important? Or the rest we can.
Can you be curious?
Can you be curious, and can you be dogged? The word Kynikos in Greek, which is the root of the English word cynic, meant dog-like. And Diogenes famously carried a lantern and a dog, and had a dog at his side. And so it's an important attribute for any investor, but particularly on the short side, where often management is going out of its way to obfuscate things or put a gloss on things that are not glossy.
So you've learned a great deal. The unlearning?
You also have to learn that things do change, right? And so although you have some signposts and yardsticks to use as your tools, business changes, the economy changes at a rapid pace. Things that you take as a given in the business world may not be a given. And you have to understand that the market will often value things that you know nothing about. And so you have to keep an open mind on that. You also have to keep to understand confirmation bias, which is, I think, the investor's worst enemy. It particularly is important on the short side because of the risk-reward nature of individual situations. The good news is confirmation bias, however, is a far bigger problem for the bulls than the bears, because their chorus is quite a bit bigger and their sound and echo chamber is quite a bit bigger. By its very nature, short selling is sort of a lonely path that you got to find information on your own and understand on your own, as opposed to have the sell side whisper in your ear what earnings are going to be next quarter.
But you invite the sell side in. As I understand it, when you're staking out a position in a stock, you want the bulls to come in and give you their best shot.
Yeah. So it's
is that an anti-confirmation bias, or is this a part and parcel of the information gathering process?
Well, it's one of the good asymmetries. We've talked about the bad asymmetries on the short side, risk reward, there's tax aspects that make it unfavorable for investors. But there's a number of really good ones. And one of them is the information asymmetry. Because Wall Street is so motivated to promote securities, if we have a position in a company or at least a thesis on a company, we'll certainly invite the sell side in and buy them lunch and put up our hypothesis on the whiteboard and say, okay, here's where we're thinking about this company. Where are we wrong? And I think that it's important, A, to be challenged intellectually, but B, I want to know what they know, and I want to know if they know or are even considering what we see. And
have you ever changed your mind as a result of such an encounter?
All the time. Yeah. All the time. Yeah, where we've missed something, of course. Where we think we see something and we don't know something.
We've talked about your greatest hits. Give us 2 or 3 of your worst howlers.
Well, in 89, 90, and 90, 91, we were short commercial real estate and a number of the troubled banks. And although we covered a number, we stayed short the banks way too long past the turn, and it hurt us in 91. The only good news on that is that I sort of learned my lesson, and in 08, as the world was coming to an end, we pretty much covered most of our financials down 80 or 90% and left the last 10% for the truly brave. More recently, there's a company that makes electric vehicles out in California.
Heard that.
And I think that our cost basis right now is about half of where the stock is.
Would you be staying with that particular stock?
I think so. I think that we tend to see that company as a little differently than the rest of the street. It is a popular stock.
We're talking about Tesla, of course.
We are indeed talking about Tesla, and it's run by a visionary, and it's been a tough short, but we're staying with that one.
Do you ever encounter, at least retrospectively, the kind of the Ahab and the great white whale problem? I mean, you get obsessed with these names and go after them, perhaps for reasons not purely economic.
We are cognizant of that. That's the ultimate anti-confirmation bias, where it becomes a jihad, if you will. And again, given our position sizing, even if we find ourselves on the wrong side of that real problem, hopefully we right the ship before it does any damage. In the cases where you worry that you're going on a crusade or a jihad, you have to really make sure that, in fact, your fundamental story is a fundamental story and not some situation as you wish it to be.
Yeah. As I was saying, okay, we are as thick as thieves. We are. You hired Emily Grant Turner, terrific analyst. I know, I heard you say that. And I, for my part, gave an interview for a kind of a friendly testimonial film on the occasion of, I don't know, 50th anniversary of Kynikos. Maybe it was 100. Anyway, it seems like a long time you've been in business. And I looked into the camera and I said, Jim Chanos, as far as I'm concerned, is kind of an investigative reporter manqué. And I think that if the New York Times paid as little as $20 million a year, he would make the sacrifice to become a reporter. What do you say about that? Are you, in fact, a closet investigative journalist who wants to set the world right, or are you a moneymaker? Which one?
Well, I hope a little of both, and more the latter than the former. But I will say that I think some of the very best analysts that have worked at our firm, in fact, were investigative journalists. So there is a bit of an overlap on that.
So they took the pay cut in good grace?
Right. As to whether we're money makers, I'll leave it for my clients to decide. But we've done okay, and we've done okay in a very different corner of the markets, and in an environment basically as you well know of 35 years of declining interest rates, rising price earnings multiples, rising corporate profits, of course, but the tailwinds to the financial markets have been nothing short of spectacular over the past 35 years. And
is that going to change? I mean, I wonder if something isn't fundamentally off in the world, and I think that the thing that might be off, in fact, I'm quite sure the thing that is off is credit, is the pricing of credit, is the manipulation of interest rates by the central banks. And they have given us such things as junk bond yields denominated in euros, beginning these yields do with the number 0.
Yeah.
Some of these things yield less than 1% to call them. I mean, this is something new in the world, these rates, and the monetary regime is relatively new in the world. Do you think about things like the monetary backdrop? Do you think about things like the other cosmic questions, or do you focus single-mindedly on discrete situations?
Well, again, remember, broadly speaking, we're in effect long the equity markets of any place where we're shorting stocks. So I think about them, and I think about what it offers us in the portfolio of choice of what to be short. So the incredibly low interest rate environment has given rise to behavior that is worse in some areas than others, and worse in some specific companies than others. I can't do a whole lot about railing at the sky of the central bankers.
Leave that to me.
But I'd be remiss if I didn't say I agree with you that as you so aptly put it, when you've got your fingers or your whole fist on the scale, it alters things. It alters behavior. It alters what people expect.
And perceptions of what is.
And perception of what is. And so you begin to see people do kind of dumb things. And that's our bailiwick.
Is this moment, with considering all things, is this moment the craziest juncture in finance that you have seen?
I would say broadly yes, only because in other times that we have sort of deemed the market to be crazy, often it was in a narrow area or it was in some specific large group of businesses or stocks. And now in 2018, we are looking at kind of global craziness, and we're looking at it broadly, that there's debt buildup, there's speculation in a variety of areas. You've got low returns in lots of businesses that is being financially engineered by share buybacks and a variety of other things to prop up the businesses. And so, yeah, I think that this is much broader than 1999 or 87 or or 2007 even.
China. You became bearish on the kind of the People's Republic of China in toto.
So I've heard.
5-7 years ago, or a long time ago. Here's what China looks today, at least to me. I mean, the witness will now consult his notes here. Okay, so China's got a banking system of $39 billion, or its equivalent. It's got a shadow banking system of 15.
I think it's 39 trillion.
Yeah. One loses track.
Yeah.
Okay, 39 trillion banking system, a shadow banking system of 15 trillion, and a GDP of 12.
Yeah.
U.S. has got a banking system of 17 trillion and a GDP of 19 and a half. So China is China does it not recall Japan in the late 80s. Remember Zytec financial engineering,
sure do.
And now in China there is the wealth management product syndrome, almost $4.5 trillion worth of so-called WMPs, which are blind pools of speculative assets that yield on average 4.5% compared to a bank deposit rate of less than 2%. The entire country is levered up in search of returns and yields. What the heck is going on in China, and what does it mean for the rest of us?
So comparing Japan to China, I would say Japan was a piker compared to where China is today. China's taken that model and put it on steroids, and has done it on, not only in terms of magnitude, but in style. A guy I really respect once called it the People's Republic of Madoff. That guy being you, and boy, is that a descriptive phrase, because as much as the macro stuff has intrigued me and you, what's so interesting about China is the lower down you get, the more micro you get, the worse it looks, and that the companies don't seem to be profitable. The accounting is a joke. There's no recourse in the system to redress should people steal from you. And so on and so forth. But getting back up to the macro view, I had to smile a week or so ago when the Chinese credit agency, Dagong, I think I'm getting it right.
Daggone.
Yeah. Downgraded the U.S. sovereign debt rating and chided the U.S. for its debt-driven economic model.
Well, the
Takes
point,
one to know one, I
the point
guess.
survives the exaggeration.
Yeah, exactly. And so, I mean, if there was ever a debt-driven economic model, we are seeing it. China is rewriting the economic history books because they now are embarked clearly on a view that they can simply borrow twice the amount of output growth, 2 to 3 times GDP, every single year, pretty much, and get away with it.
Debt is twice as much as GDP. It's growing twice as fast.
Yeah.
About.
Yeah. And so on a year where it slows, GDP grows 7 and debt grows 12, right? That's
and of course, the marginal oomph from the extra dollar or yuan of borrowing diminishes.
Well, of course. And you get to the Ponzi finance part where more and more of the debt, new debt, is going to just simply keep the old debt current. And this is the problem when you get a banking system over 400% of GDP.
There is a bigger than Japan
far bigger
debt bomb out there.
Far
There
bigger.
is the lunacy, shall we call it, of, I don't know, from the South Korean small cap market to the cryptocurrencies.
Yep.
Will there come a time in which you lift your long index hedges and just go all in bear?
Probably not. Again, it just because our view is that I don't know where markets go. Now, there will be times in which we get riskier in the short portfolio, so in effect you become more short.
Are you at maximum short now? Minimum short,
We're up there. Yeah, we're pretty close.
compared to what?
We've been more.
When?
Tactically, 2006, 2007, probably 99, and probably 89, but not by a lot. I mean, we're close. And so I think that to get back to China for a second, I can't help but underscore that the single most important asset market in the world remains the Chinese residential real estate market, because the Chinese residential real estate market represents half of their investment every year, about 23 to 25% of GDP. China is building 20 million apartment flats a year. It needs about 6 to 8 to cover both urban migration and depreciation of existing stock. So 60% of that 25% is simply being built for speculative purposes, for investment purposes. And that is, that's 15% of China's GDP of 12 trillion. Put another way, it's about $2 trillion. That 2 trillion is 3% of global GDP. And so I can't stress enough of just how important that number is and that activity is to global growth, to commodity demand, and a variety of different things. It is the single most important asset class in the world.
Are you short it?
We are short it, and through a variety of different ways. But interestingly, we're less short China now than we have been in 8 years in our global portfolio.
Why is that?
Because the rest of the world's catching up. Although China's been on a tear recently, Chinese stocks over the 8 years are basically flat. And I've noticed that some of the other stocks have sort of tripled.
How do you invest your, if I may ask, how do you invest your own money when you're not shorting? I mean, you're a human being who has needs of income. I mean, you're a bear, but also you're a person.
Yeah, sure.
And so, how do you do it? I mean, how do you?
Well, since we've had our hedged vehicle since the mid-90s.
No, I mean, you, if I may. Personally, yeah.
But most of my investable assets are in the funds. But I've asked that my partners and I keep it in the hedged vehicles, not the short-only vehicles. So I think that like most hedge fund managers, you know, we have to eat our own cooking, so to speak. And so,
how's it taste?
Good? You know, sweet and sour.
The portions are so small.
Sweet and sour.
Well, this has been pretty terrific. I think I ought to not wind this up before asking you about dear alma mater and about your not-so-secret other life as a professor. You teach a course both at Yale and at the University of Wisconsin, kind of a sentimental alma mater. And I'm going to ask you one thing about that. What is the single most important thing that you teach your students?
So the single most important thing I teach my students is primary research. And although it's nominally a history course, it's a course on the history of financial market fraud. We overlay some systematic models on a historical narrative. What I stress to my students and my analysts is the importance of working the opposite way of most investors, and whether it's examining something historically or something currently. And the parallels hold. So what I try to teach and really reinforce to the students is that it's shocking what you can find out when you do primary research. Because most investors, if you think of investing in an idea as sort of an onion, whereby the kernel of the onion is primary source documents. The second layer is sort of company press releases. The third layer would be conference calls where management expounds on their business. The fourth layer would be sort of Wall Street research reports. And the fifth layer would be stories, rumors,
the good stuff.
Tips, the good stuff. Virtually all investors work from the outside of the onion in. You know, they hear a story, they might read some research, they might listen to a conference call. I tell my students, start with the documents. Start with what the companies have to tell you or are mandated to disclose and work your way out. Often the same situation looks radically different when you start that way as opposed to when you start with the chorus and their interpretation of that kernel of truth. And it has put my analysts, I think, the firm in good stead in doing that kind of research, whether it's historical or current. And it's kind of amazing what you find, you know, when you read the Enron 10K and read the footnotes, as opposed to listening to what the sell side was saying. Yeah. Or you see what Mike Pearson at Valeant was doing with his acquisition accounting, despite what Wall Street was saying. And that's something that we sort of reinforce with historical examples. And I hope if my students, you know, take anything away from the class, it's that.
Well, Professor James S. Chanos, thank you. What a delight it's been.
My pleasure. Thanks, Jim.
Well, that was Jim Chanos. And what a pleasure it was to be with him. You know, he told us how he goes about this very curious business of selling stocks before he buys them. The art of short selling consists of checking facts, of peeling, as he put it, to the center of the onion, never mind the watering of the eyes. And once you get an opinion, to check it, to persist in it in the face of persistent negative reinforcement from the outside world. Well, he's a great analyst and a great guest. And thank you for being with us on Real Vision.
Do you have specific bow ties for certain occasions?
So like days of the week underwear? No, I don't. I mix them and match them, actually.
Okay. Definitely keeping that one.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.